When it comes to investing, it can be a very tricky business, which is what we're going to be covering in today's video. Some investment tips that everyone needs to know before we start putting our hard-earned money on the line and putting it into investments. First things first, cleaning up your financial. Before you get serious about money, before you get serious about investing money, look at other financial aspects of your life and what do they look like, including paying off your debts. When you think about investment returns, when you think about the compounding, if you're sitting on that high interest debt, if you have credit cards, chances are you're going to get a lot more kind of bang for your buck if you're paying off and eliminating that debt prior to getting into that investment. Now, of course, when we think about retirement, make sure if your company has a retirement plan, if it has a 401k match, it is something you want to prioritize number one when it comes to investing because you are getting 100% return and you are getting free money. In addition to this, having that emergency fund and having it set up, when we start looking at 3 to 6 months of an emergency fund, there can be a great variance with the amount that you're putting in there. And for me personally, with the emergency fund, it depends on the industry you're in. It also depends if you do have two incomes, meaning it could be, a husband, significant other, a spouse, any way that you really look at it. How much income do you have? If one income is eliminated, what is it going to look like? That is going to determine if you're building a 3, 4, 5, even 6-month emergency fund. And also, what kind of job do you possess? Is it something that is sales orientated where your salary can actually, change a lot? Or is it very set, very concise with what you're getting? The next one we look at is spending. There will not be a video where I don't talk about budgeting. I don't talk about the savings plan, the spending plan. You have to know exactly how much money is coming in every month, how much is going out, and what exactly do you have left to invest. When it comes to thinking of the big picture, what are the goals that you have for that money you're investing? Does it mean that you're looking and investing in, the next 3 to 5 years? Are you thinking of retirement? Is it child's education? What is the investment strategy and what goals do you have? Is it you want to retire and have $5 million in the bank? Exactly what is that going to look like? And of course, you don't want to lose sight of that bigger financial picture of exactly why you're doing what you are. And when it comes to investing, thinking about the long term. When we think about long term, when we think about investing, we are looking at 5+ years for investments. This is the reason why when you think of long-term and compounding interest, this is where it is really going to come into play, is when you start getting an extended amount of time. When you think of a timeline of 10, 20, 30, 40 years till retirement, you have the ability to compound a lot of the returns that you get in there and also can really exponentially just to the moon with the money that you have in there. Now, of course, like we said earlier, when it comes to research, you can never have too much research. There is no point that reading enough, consuming enough content, looking at financial education videos, looking at trading, investing in stocks and ETFs. There is so much, and over the past 5 years, I've digested an incredible amount of content around investing, around really knowing what we're doing and knowing the industry that we're in when it comes to investing. Now, of course, when you think of investing, when it comes to research, what are you investing in? A lot of people might recommend a bunch of different stocks. They might recommend ETFs like we were talking about. But when it comes into putting your hard-earned money in there, what is the anticipated return? What are you looking for? And what are you investing in? This, of course, applies wholeheartedly to cryptocurrency. If you don't understand blockchain technology, you don't understand exactly what you're investing in and what the risks are associated with investing, I do not recommend under any means to invest. And of course, when it comes to YouTube, when it comes to a lot of different places, don't believe the hype. There's a lot of people that hype up a lot of things, gets views, get a lot of different things. Even looking at the industry, where AI technology is going on. A lot of people are following and putting money into artificial intelligence. And honestly, do your research when it comes to this technology, when it comes to everything. If you're investing in one single company, which of course I do not recommend, putting it into ETFs, kind of risk mitigation, being invested in a multitude of things like the S&P 500, for a majority of people is going to be the absolute best option. Now, of course, you also have to know when to take a back seat, when to sit out, when not to play the game. When you think of the hype of Bitcoin, when you think of Ethereum, when you think of all the ETFs, a lot of people bought into them and then a lot of people lost money. When you start seeing kind of the trends and seeing everyone talking about the exact same thing of what's coming, this is really where you might be too late to the game. When you think of Bitcoin and when you think of a lot of people that have made, multimillionaires out of it, if you don't understand what you're investing in, like we said before, do not invest in it. Now, of course, when it comes to investing as well, being more protective about the investment. This is the risk mitigation. When you think in looking at companies, are you a person that buys and holds? Are you a person that will buy a company or invest and sell it for a short-term gain? You have to know exactly what you're in, and you also have to know what your risk appetite is. Are you willing to really put a large sum of money into a very risky investment? Of course, there could be a big upside to that. There could be a big positive side, but you could also lose your initial investment or even more money depending on how you're doing it. But there's also a time on the flip side when it makes sense to be greedy. When you think of times to be greedy, this is when you can buy ETFs cheaper. Now, me personally, this is when I take full advantage of it. The time to be greedy is when we see a dip in the market. Thinking back a couple years to 2022, when there was, markets were down about 18, 20, 25%. That was the time you were buying it discounted. When you think of the time to be greedy, that is it. It is. When you think of ETFs at a 20 to 25% discount, that is the time you want to go ahead and you want to pump money into this, because of course we are looking at not timing the market, but being very consistent and having the ability to buy when the market is lower. And when it comes to purchasing those, we talk about diversification. There's no time when it comes to investment tips that we will not talk about really the diversification. You do not want all of your eggs in one basket. You don't want everything into one. Now, there's going to be a couple things to remember this depending on your age, your interest, the investment capabilities, what exactly you're looking for. The investment portfolio is going to be different, and it's going to be a different landscape for everyone. This is where the diversification comes in. Something like that S&P 500, where you're in every single sector in the market and across a plethora of companies, makes a very big difference. Now, when you start looking at this, look at the prospectus, look at the companies, look at the ETFs, look at the data sheets that they provide to you to see exactly what it's going to be. Now, of course, you cannot really predict any future growth, future changes, future anything when you look at what happened in the past. However, when you start looking at data at a bigger scale, it makes sense. When you look at the S&P 500, it has made about 10% every single year. There's nothing to say in the future we're not going to see that 10% gain over an extended amount of time, that it's not going to be going anywhere. And that is where people continue to invest. So when we start thinking of the stock market as well, you have to zoom out. You have to take a step back. When you think of it being a very bumpy ride, it's going to be ups and downs. You're going to have highs like we're seeing this year where the S&P 500 is up 20%. But are you an individual that can handle the downs, that can handle when the S&P 500 is down 20% and you're losing, thousands, tens of thousands, hundreds of thousands of dollars, depending exactly how much you have in there. Now, when it comes to investing and when it comes to putting money into the investment, you have to take emotions out of it. This, of course, took me an extended amount of time to be able to do, taking my emotion out of here and really looking at the numbers. People will see the market go down, they'll see it go down, boom, they start selling. So they're selling it at a much lower value than what they possibly bought it at. But then again, on the flip side, what happens is emotionally, we start seeing something going up, looking at NVIDIA, we start seeing the green, we start seeing the growth, we start seeing it take off. All of a sudden, people are right on board. They're on the trend, they're throwing money into NVIDIA. It continues to rise, it continues to rise. Where there's a point, price to earning ratios, where a company will pull back. They're not, and they're really overvalued at some sense. Not saying that NVIDIA is right now, but overall, you have to think and you have to take that emotional aspect out of there. And of course, take headlines with a pinch of salt. Do your own research when you start thinking of companies and when you start looking at what is in the headlines today, what is in the headlines tomorrow, what is going to be there in the future. Bad news can drive a stock down, but majority of the time, it is very temporarily that we see the stock pull back or really do some recession. And of course, reinvesting. This is a major point that people have to get when you think of reinvesting your dividends, reinvesting your capital gains, reinvesting. This is where the compounding comes in. There's going to be a point in life where you might want to take some out of this investment, but it keeps and helps your portfolio growing much faster and really slingshots it into a very easy part. Now, when we think of simplicity, this is another one. When you're choosing stocks, when you're choosing ETFs, you really should consider index funds. Again, that's exactly what I invest in and only what I invest in my 3 ETF portfolio. And I do change my percentages through time. But overall, imagine if you just put in something like the S&P 500, investing in the VOO or the SPY, putting your money in there is going to yield you roughly 10% every year. If you have it for an extended amount of time, you are going to see that growth. When it comes to investing, it is very time consuming. When it comes to just leaving your money there, it's very boring. When you see films and when you see a lot of trading, day trading, and the ups and the downs and everything, for majority of investors, think of your 401k. Think of putting money in there every week or every 2 weeks when you get paid. It is going to grow over time, and it's going to grow over an extended amount of time to build the portfolio that is required when it comes to retirement to actually be able to live the retirement that you want. And of course, you have to think of fees. Watch out for fees. 1 to 2% doesn't seem like a lot. When you start compounding it over 30 years, that could be roughly 20 to 30% of the value of your portfolio because of fees that you look in there. And the biggest thing when it comes to investment is consistency. We always talk about this dollar cost averaging. If you're putting money in there every 2 weeks, if the market's up, that's great, you're buying. If the market does go down, that's great, you're buying it at a discounted rate. Putting money in here and continuing to invest on a regular basis. You don't have to make investing complicated. Doesn't have to be super difficult to understand. Even when it comes to an ETF, if you just put it into one, like the S&P 500, you would do incredibly well when it came to the returns. So, all right, guys, so that is going to do it. Investment tips everyone needs to know, and these are just the very, very basics. As we continue, please subscribe to the channel. We'll get a lot more in depth with the investing strategy, and thank you guys for watching.